We're in the midst of a fundamental transformation of computing architectures. We're moving from a world where we create data, we store it, we retrieve it, then we harmonize it, blend it, and present it so that we can make better decisions. We're moving to a world that creates content from knowledge using tokens as a new unit of value, and increasingly takes action in real time, with or without human intervention. This is driving unprecedented increases in value. Now, what this means is every part of the computing stack, from silicon, infrastructure, compute, storage, and networking, security, middleware, development tools, applications, and even services, is changing. As with other waves in computing, consumer adoption leads us up the innovation curve where the value is clear, the volume is high, and the velocity is accelerated. And this leads to lower cost and eventual adoption into and disruption of enterprise applications. Now, importantly, to do this work on today's data center infrastructure would be 10 times more expensive. And that's trending toward 100 times more expensive by the end of the decade. And as such, virtually everything is going to move to this new model of computing. Hello and welcome to this week's theCUBE Research Insights, powered by ETR. In this breaking analysis, we quantify the 3 vectors of AI opportunity that were laid out by Jensen Huang at his keynote at GTC 2025. That 3 being AI in the cloud, AI in the enterprise, i.e. on-prem, and AI in the real world, i.e. robots. And to do so, we welcome back David Floyer to the program, and we'll introduce a new forecasting methodology that he's developed to better understand and predict how disruptive markets evolve. David, welcome.
Thank you very much. It's great to be working with you.
Yeah, very excited about this conversation. Of course, we're in the midst of, tariff turmoil. Markets are down, NASDAQ down another 1,000 points again, back to back, worst week since March of 2020, which many of us would love to forget. And so what I wanted to do to set the backdrop, David, is ETR has just finished its latest survey in the field. And one of the things they do, Andrew, if you bring up the first chart, one of the things they do is they survey each quarter as to what IT decision makers expect their annual spending to look like. Now, we showed this last week, and it's still preliminary. ETR hasn't published the final, but this is pretty close to final. You can see that blue line that says COVID spending spree. We exited COVID at over 7% expectations for IT spending. And as the Fed tightened, we've talked about this a lot, we saw expectations bottom at just under 3%. And then in 2024, we actually grew IT spending at around just under 4%, 3.9%. And we entered in January 2025 with the expectation of 5.3% IT spending growth, up from the October survey, which was 4.8%. You can see that in the purple. But what's happened is the April sentiment has pulled back, and now we're back down to 3.4% below last year's spending. Now, ETR has also done a recent survey where they were querying about actions as a result of tariff turmoil and privacy and regulation and other public policy around AI. And I would say, so this is an N of 500 in a larger survey. These are the portions of the survey that indicated they're actively adjusting or have already implemented changes to its IT strategy due to those factors that I just mentioned. And you can see here on the left-hand side, about half the respondents, a little over half, are staying the course. Either they're continuing their planned adoption pace of AI, or they're even accelerating it so they can get ahead of the competition. Of course, there's a big fat middle that is staying right where is always planned to be. Sort of we'll wait and see, but we're going to continue to keep our eyes open and our toes in the water. And less than 10%, 9% are slowing AI adoption due to all of these public policy concerns. Thank you, Andrew, for that. So, David, we've got some headwinds at the macro level, but it seems like AI adoption is going to continue, at least for now, unabated. Just one caveat is this survey most of the survey respondents were before the stock market has dropped precipitously. But what do you make of this data?
Yeah, this data is, to me, it shows a little caution, this data. And I think in any new migration, they're looking at the whole problem, the whole disruption that it's going to cause. Maybe some of them are hoping it's going to go away. Those are my observations that this is such a large, amazing disruption that they haven't got their arms around it yet.
Yeah, okay. So let's now get into it. So at GTC, Jensen laid out 3 vectors of opportunity for AI. The first one he said was AI in the cloud. So we talk about public clouds and cloud service providers. Very early in his keynote, David, he said, quote, AI started in the cloud for good reason. It needs infrastructure. So explicitly, he was talking about, crediting cloud service providers like AWS and Azure, GCP. He mentioned specifically those 3 plus Oracle for supplying the big compute and the talent, of course, they have that talent. And he used repeatedly phrases like AI factories in the cloud service providers and how they ramped up very quickly. He discussed Hopper at Blackwell, huge GPU deployments, all these major hyperscalers. So to check the boxes there, that's where all the action is on AI today, or vast majority of it. And we're gonna quantify this further. And then the second was AI in the enterprise. We're talking here about on-premises in private data centers. Now, when we talk about, let me go back to the cloud for a second, David. We're talking about cloud service providers, the big hyperscalers, the public cloud service providers. Consumer is really driving this, and this is one of the premises that we'll unpack today. But we're including OpenAI, we're including Meta, we're including Apple, we're including ByteDance and TikTok. Those are the quote unquote hyperscalers really driving AI, as Charlie Kawwas said a year ago at the Broadcom analyst meeting, the financial analyst meeting. AI in consumer, the ROI is obvious. It's not so obvious yet in the enterprises, is what he said. Okay, so that brings us to the second piece of Jensen's opportunity map, AI in the enterprise. Again, talking about on-prem, private data centers. Now, he didn't talk about this, but we do a lot. There's data gravity, and that data is not going to move into the cloud, at least not without a fight. So people want to bring AI to the data. So that's why this is an opportunity. The problem is, and again, we're going to quantify this, the problem is that those stacks on-prem are not built out yet. You have Dell with, for instance, the AI factory, and HPE has its solutions, but they're largely hardware-based. They don't have a lot of startup content yet. They don't have a lot of up-the-stack solutions yet. Those are being built out, and we're going to, again, quantify what we think that looks like. And then AI in the real world, what he was talking about there was physical robots. Really, in the latter part of the keynote, he talked about physical AI and robots of every kind. And we're going to break that down into single purpose robots and basically humanoid robots. And Nvidia showed it, the Isaac robotics platform, and Blue, the humanoid demonstration. So we'll unpack that a little bit. We're not going to forecast that today, but we will talk about, some of the dimensions of that. Andrew, if you bring up the next slide, this is a forecast that David generated a month or so ago when we were looking at the impact of data center spending. What this shows is all data center spend, and it's updated as of 4/25, as of today. You can see in the early part of the forecast, 2019 to 2023, we're talking about a couple of $100 billion. We saw a decline in 2020 due to COVID, and then it increased again as we sort of relied on the cloud. But the brown in this is traditional data center spending. So we're talking about largely x86 general purpose computing. The blue is what we called extreme parallel processing, EPP, otherwise known as accelerated computing. That's a term that Jensen uses. That's the blue bar. So I'll call your attention to what happened in 2024. We went from that blue bar, we went from 43 billion to 180 billion. And it's exploding. And we're forecasting a $1 trillion opportunity by the early 2030s. So you're seeing the data center business overall is growing at a 16% CAGR over an 11-year period. The traditional data center is in decline over that period, and the extreme parallel processing, the accelerated computing at 23% CAGR. So massive transformation, David, underscoring what we had talked about before. I'll let you pick it up from here, and then we'll make a few comments on the data. What would you add?
So this represents such a huge change in spend on IT. You look at 2024, and it's gone from 220 to 350 in just 1 year. And that half of it is the new AI extreme parallel processing. And if you project that out, it means that we're going to be spending 5 times as much on IT by the end of the decade, and 10 times by 2035. That's a very massive increase in rate of spending on IT, and this represents the slow decline of the current traditional data centers. It's going to take a significant amount of time to move stuff off to create all of the new software and hardware stacks required. So that's going to decline slowly over the period, but all of the action is going to be in the AI data centers.
And now I met, thank you, Andrew, appreciate it. I met recently with Arthur Lewis, who runs ISG for Dell. When he saw this forecast, I shared it with him. He goes, yeah, but that's a lot of cloud. That's mostly cloud. It's virtually all cloud, hyperscalers. And he said, you got to break out those blue bars, which is exactly what we're going to do. But before we do that, actually, Andrew, go back to the slide if you would. I just wanted to point out that extreme parallel processing, that accelerated computing, just look at that. It goes from less than 10% in 2020 of the total market to 85% by the end of the decade. We can't underscore enough how dramatic this shift is. It's more dramatic than anything we've seen in the past. Nvidia today has about 25% of this data center spend, which is phenomenal. And we think it'll hold that. We don't see just a ton of competition there, although when we start to getting robotics, that's not included in this forecast. Thank you, Andrew. So what we want to do now is we want to talk about sort of how we came up with this. David sort of is thinking behind this, and a new methodology that he's been working on and that we've been using here at theCUBE Research and applying to these disruptive markets and these forecasts. So Andrew, if you bring up the next slide. This is David's 3 V's forecasting methodology, not to be confused with the Gartner 3 V's of big data. This is about volume, value, and velocity. And David, I'll just briefly go through this. But the basic premise here is when you have disruptive technologies like this, you need new approaches to forecasting. And we often use Wright's law. Wright's law basically says that as your cumulative volume of output in manufacturing doubles, your costs go down by a constant. And this applies in whether it's you're making airplanes or silicon. And it certainly applies here for AI. And so we want to extend Wright's law beyond just the volume. We want to pair it with value and velocity, because value drives demand, and that drives innovation, and that lowers cost. And then velocity means things happen quickly, things get replaced more quickly. That means faster adoption. So speeding up improvements is going to further reduce costs. Think about Moore's law. Moore's law, every couple of years, things went down in cost. Well, if you're speeding up those improvements, which you're seeing today, we've talked about this a lot on Breaking Analysis, the pace of compute escalation is much, much faster than traditional Moore's law. That brings down costs faster. So all of that combines for a new forecasting methodology. So if we think about new markets in the context of their volume, their value, and the velocity of change and innovation, it gives us a better picture of the true growth of something like AI. Thank you, Andrew. And we think that leads to better long-term forecasts. So David, you are going to publish this. You've published it internally, quite a nice paper on this methodology with detailed calculations and the like. What would you add to my very rudimentary description of this methodology?
Just going back to the three V's, obviously, there are equations which describe Wright's law. So what I've done for a long time is look at value and look at velocity, and velocity and value can be negative and positive. If you look at x86 now, it's probably negative, and HDDs are definitely negative in value. They're being replaced. Velocity is also positive and negative. So velocity is, for example, is very, very high in the consumer area. It was very, very easy to start with AI. We just signed on and typed in, and it instantly understood what we were trying to do. There was no very, very low learning curves. However, in some of the areas that we're going to talk about, particularly the enterprise, that velocity is not nearly as quick because they have systems and they need to bring those systems over or integrate with those systems. And that's going to take time. It's going to take a lot of software. It's got a lot of software stack. So that velocity slows things down. But the value of AI is immense. The productivity that is happening to consumers with it is just phenomenal. And that's why people are using it all the time. If you look at previous ones, like the PC to begin with, the value was good and it was adopted pretty quickly, but it wasn't nearly as high as today's value. And the iPhone and mobile, that was a higher value, but the value of AI is absolutely enormous, and that will drive volume, huge volume, and velocity is the thing that'll hold it back.
Okay, so thinking about that data center forecast and thinking about Jensen's three vectors, another V of opportunity: AI in the cloud, AI in the enterprise, and AI in the real world. Okay, so Andrew, bring up the next chart. What we're going to show you now is we're going to isolate in on those blue bars from the previous chart and focus just on the IT portion, or sorry, the AI portion of that data center forecast. And you can see that here. Okay, and we've split it into two, those first two of Jensen's opportunity maps, which is AI in the cloud and AI on-prem in the enterprise. And you can see here that AI in the cloud is the dominant portion of the AI adoption, certainly in the early days. So the cloud dominates, as Jensen said, for good reason. It has the tooling, the hyperscalers have the skill sets, and they have the
velocity is low.
Say it again.
Velocity is very high on consumer.
Yeah, and that's right. And this is being driven by consumer. It's, again, Charlie Kawase, Meta for targeting ads, Google for search, ByteDance and TikTok, Apple. These are consumer applications where AI is driving clear ROI, justifying, the CapEx. And then the next wave is enterprise AI. It's slower ramp, but it crosses traditional on-prem by our forecast in 2029. I want to call your attention to something that Jensen said, David. He said, I want to thank you, everybody here in the audience. I want to thank you for making a fundamental shift from integrated NVLink to disaggregated NVLink. We're going to talk about that later. From air-cooled to liquid-cooled, from 60,000 components per computer to 600,000 components per rack. 120 kilowatts, full liquid-cooled, 1 exaflop in a rack. Okay. Why did I bring that up? Because The hyperscalers have done that, but the enterprises have not. And you can see that in these forecasts. The enterprise, data center AI platform really doesn't start to take off until, it starts in getting steeper in 2026 and then really ramps up in 27, 28, 29. The point we've made is, yes, there's data gravity. We need to bring the AI to the data, but those stacks don't exist. The skill sets aren't there, certainly not in the way they are in the cloud. Yeah, JP Morgan Chase has the ability to go build this out. The big banks have the ability to build this out, but most enterprises need solutions, and those solutions today don't exist in volume. So David, even though we have this, so we have this, the AI portion of this at $1 trillion by 2032, where 20% of the opportunity is on-prem. Jensen showed a Del Oro forecast that showed data center at $1 trillion, probably a little bit before that. This again is just the AI portion. How did you apply the 3 V's to this, and add some color to what I just shared, please?
I think you did a very good job of describing the issues with the enterprise. I just want to focus on one thing on the cloud. The cloud is obviously for consumers, but like the PC and like the mobile, those consumers include a lot of business. So individual people in businesses are going to be, their productivity is going to be improved. They're going to be able to program faster. They're going to be able to research faster. So it's going to already have a big impact on productivity within the data center. In addition, there will be the start of agentic AI in it, and these tools will start that process. I'm a little bit less enthusiastic about agentic AI because I think that it adds a layer of complexity on already very, very complex system where the data itself is not coordinated, is not in line, and there are lots of processes. So I think agentic AI is going to really take off when the platforms are in place and real-time systems can be used across the board, across an enterprise or within a division.
Yeah, thank you for that, and thank you, Andrew. Yeah, David. I mean, agentic is another abstraction layer, but the gap that we've talked about a lot on breaking analysis with George and others is the data piece. The data is not harmonized. It's obviously has to be governed. If you want to build a real-time representation of the enterprise, you've got to have access to legacy metadata, business logic, and very importantly, as you just mentioned, processes, and I would add transactions. So yeah, you got platforms like IBM Z and Oracle that have transactions. Well, you're going to need access to that. SAP, Celonis is suing SAP over access to that data. Of course, Celonis is a company who's working hard on harmonizing that data and enabling agentic AI. So it's going to take some time to build that out. Let's talk about, Andrew, if you bring up the next slide, let's talk about robots. That's the third area that Jensen talked about, AI in the real world, physical AI and robotics. So, here we're showing on the left-hand side a single purpose robot. It does one thing. It's in a factory. It does it really well. It doesn't need to sleep. You got to oil it every now and then, tighten the bolts if it loosens up.
Another robot does that.
Yeah, another robot will do that, exactly. Maybe the wires get loose. You've got monitors on this thing so you can tell when it's going to fail, and you can have, predictive maintenance, et cetera. And then on the right-hand side, you've got Jensen talking to the little humanoid robot, which I found quite interesting. I mean, he highlighted examples like Foxconn and others simulating robotic deployments in Omniverse and saying that everything is going to move to autonomous. In last year's keynote, or David, maybe it was in CES this year. I think it might have been CES. It may be both. He basically said, thank you, Andrew. He basically said that there's only some finite number of human movements. And, we know what those are. It's throwing, catching, jumping, lying down, running, jogging, standing, sitting. But there's a lot of those. And so let's apply, if you bring up the next slide, Andrew, let's apply the sort of 3V's thinking to robots. Let me summarize here, David, and I'll bring you in. Basically, the point that we're making here is we believe in the future of automation and that robots are fundamentally the path to get there. Very high volume, going to be high value, but really disruptive. And David, you've made this point a lot. New companies are going to have new metrics around revenue per employee. They're going to be far more productive because they're going to start with AI native processes. And the velocity is very good, especially with the closed systems. The one on the left that we just showed you, factory, transports, military stuff. But those open-ended humanoid robots, very complex, and it's going to be slower to adopt because of the complexities of the physical world. And the last word here is on tariffs. You came up with actually kind of a non-intuitive point here, but tariffs in a way are a blocker because what you want as an exporter is to be the world's lowest cost automated exporter. And if you introduce tariffs, on the one hand, it will lessen potentially the urgency of automation.
The marketplace, yes.
In the market. And it gives others time to catch up. So thank you, Andrew. So David, over to you. Apply your 3V's thinking to robots and how you see that playing out. And we will in the future forecast this as we did the previous slide.
Yeah, I mean, the future of automation, again, is so disruptive, the value of doing this. If you have robots that can drive for you, it reduces the cost of transport enormously and increases the value of that transport. You can drive down to LA or wherever, where I live in San Francisco. So you just overnight and just lie down there or whatever it is, or you can be working. Enormous improvement in things like transport will happen. Those are closed systems. Those are closed system robots. They'll be in the factory, they'll be in transport, and military is going to change in a way that is almost unbelievable. We've seen the beginning with drones and some robots in Ukraine, but the potential for the change for military is undeniably one of the biggest changes that will happen. And the velocity, so looking at it from the value point of view, the value in the factories, lower costs, less mistakes, being able to adapt very quickly to change. And transport, much lower costs, much safer transport. The inhibitors to this, the velocity that this will happen is pretty quick. Factories will be able to change over. Transport will happen. And the military probably will be the slowest because they have got a whole lot of issues in getting anything done. But the single point I want to make here is this is a real opportunity for new companies because they can start from scratch. They can design the whole company around automation. They can eliminate all of those slow processes, eliminate huge amounts. And what I'm forecasting is those new companies will be in the range of $10 to $100 million per employee. And the biggest risk to the existing companies is that they will come in much faster. If the existing companies don't drive hard down this line, they will be disrupted by the new companies coming in with far better designed companies. So But on the open system humanoid robots, these are much more complex. And in my opinion, will take a lot longer to adopt because they've got to deal with the physical world. That's fine. Humans, there's got to be some way that these are going to work together. Other robots, or all of the cultural issues here, the edge cases, what happens if they, fall in the swimming pool? There are so many different complexities here that I see that as that will be the velocity of that initially will be much lower. So most of the robots will be in the closed system at least for the next 5 years. And then the tariffs. This is an opportunity for the US and leading it to become like Britain was during the Industrial Revolution. They were the low-cost providers. They exported to everybody their goods. And US has an opportunity of doing that. And I hope that they will take that opportunity.
Okay, good, thank you. Okay, so it was ironic. Jensen, one of the Wall Street analysts called last year's GTC the Woodstock of AI. I had said it was the most important event in the history of computer events, and I believe that. Ironically, he called it the Super Bowl of AI this year, a term that John Furrier used well prior to GTC 2025. And the point being, the first one is the Big Bang, and then subsequent GTCs are big. They get bigger each year, and more people attend each year. Jensen even said, we got to make San Jose bigger. That's true. San Jose Convention Center is too small for 30,000 plus people, but nonetheless, the Super Bowl is an apt metaphor. And if you bring up the next slide, there's a few takeaways from GTC that we wanted to focus on. Many folks, John Furrier and many other news outlets, SiliconANGLE for sure, Rob Hof and Mark Albertson and the team, laid out, very nicely what was announced. There was a lot of opinions now. It's just a couple of weeks ago, but there were a few things that we wanted to call out. We completely buy into the notion that this is a transformation of computing architectures, a wholesale transformation, as we showed you with our forecast. Let's take these one at a time, David, and unpack them. Jensen made a big deal about disaggregated systems and distributed systems. Werner Vogels from AWS talks a lot about distributed systems, given many, many talks on it. But Jensen's talking about something different. And also, we're talking about a full range of systems here. Jensen often stresses, we're not just a chip company, we're a systems company, and you've acknowledged that early on. What's different about these disaggregated systems? Why is it important? And what did NVIDIA have to do from a networking and computing architecture standpoint to achieve that? And why should we care?
Well, if you look at the new data center, you look at the amount of compute power, it's hundreds of times greater in the same area, same cost. If you look at the storage, for example, you've now got water-cooled, incredibly dense SSDs operating as close as possible to minimize any delays. You're looking at the networking architecture, which is allowing these systems to run across multiple racks, filling up a whole data center. So they're distributed within that data center, and the pieces can be used for different areas, but dynamically, completely dynamically. And this architecture is so different from what we have today. It is fundamentally different architecture. It is really stretching communications. There'll be new communications coming, photonics and things like that. It's stretching the storage systems. It's stretching every piece. And what's required within that, of course, is not just the hardware, but the software layers and the overall architecture, and CUDA and all the things that come from CUDA are absolutely essential for making that work.
Okay, great. Let's stay on this slide and go on to the next point. That brings us to the operating system. I think about hardware exploitation, software exploitation. Dynamo is the OS of the AI factory, an announcement that Jensen made at GTC. It is designed to support agency, despite your skepticism. It is, that's the direction. So what was your take on Dynamo? Why is it one of the 3 or 4 items that we felt were key takeaways from GTC this year?
Well, it's providing the operating system for inference, and inference, as we've always said, is going to be the bigger part of the spend over time. At the moment, there's a lot going on into making the models, training the models, but in the long term, it'll be inference. So they have come up with the operating system to manage this, making sure that things can be spread across multiple racks, GPUs, etc., to minimize the elapsed time for doing anything. And it also supports ARM-based computers and x86. So it allows a transfer, it allows a method for bringing in data and other things from other platforms. So I think this is one of many, and we should look very hard at the improvements that are going to come out in this area. This is going to be the Microsoft NT of 20 years ago. This is a very, very important announcement, and it's something that's going to facilitate migration from x86 to the ARM-based GPU systems of the future.
Interesting. Today is Microsoft's 50th anniversary. CNBC's out there. Andrew Ross Sorkin is out there he's got Gates, he's got Ballmer, and he's got Nadella, and they're having a love fest, which has been quite interesting to sort of semi listen to as we were working on breaking analysis today. But you had said something as we were prepping for this. You said Jensen is executing on an Intel replacement strategy, full stop. And I changed this bullet to Wintel and I got to give Crawford Del Pret credit for this. He was the first one, I think, that came out with that, Wintel analogy. We were debating, with Dave Itcheria at Mongo, are they Cisco or are they Google? And Crawford chimed in with, no, they're Wintel all in one. Point being, they've got the hardware and they've got the software, and of course, beyond Intel, they've got the systems. So they're a systems provider. What was your point about the Intel replacement strategy? Our data forecast that we showed clearly indicates that. What are the similarities and what are the differences between Wintel and Nvidia?
That's a very, very profound question. Yes. I mean, if we go back to Wintel, they were helping each other. Windows was the primary PC operating system. It built its systems around the architecture, around the x80 architecture. It asked for new things from Intel, and Intel focused on just producing the chips to the specs dictated by Microsoft. What's different here is that there's not going to be a single, they're going to provide both of these two components, but if they're sensible, they'll do it in a way which doesn't mean that all the software, they'll be setting the base layer and allowing other systems to exploit it. it's essential that they do that and not do what Wintel was, which was a total package, all included. So they're going to be, for example, databases which are going to be GPU and are going to allow real-time analysis of huge amounts of data. Those need to be accessing old data and new data. They need to run on x86 and ARM, and there'll be a slow migration. So I thought the design of this and what they're focusing on was exactly right for minimizing the friction, minimizing or increasing velocity at which systems will be able to come and run on their hardware. And those systems, are not just in the data center. They're distributed on premise. They're going to be systems also out at the edge as well.
Yeah, we'll talk about that. But before we go there, I want to just make a point about volume. The ubiquity of Wintel won in a large part or occurred because of the cost advantage. x86 beat RISC because it had the volume advantage, because it had PCs. And you have Sun Microsystems and Digital Equipment Corporation and MIPS and a number of others trying to, IBM pushing RISC, HP, trying to push RISC systems, reduced instruction set computing systems. They didn't have the volume, and as such, they couldn't compete on cost and attract the type of developer momentum that Intel and Microsoft were able to. At the same time, Microsoft showed us new volume economics in software where the marginal cost of the next version of the software at the time went down to the disk on which it was shipped. There was virtually no cost to do the next one. And so it was able to bundle all of its different platforms together. Its spreadsheet, its PowerPoint, and its word processing together in a single suite, and just overwhelm the industry with volume. So volume applied here, it drove value, and the velocity of the ecosystem accelerated and just basically put everything else in the back burner. The last thing,
one other point I'd just like to make to that is that consumer came first. So the vast amount of the volume was from consumer. And even at the end, even today, consumer is still around 2/3 of the revenue that comes into Intel. So it was the consumer volume of x86 which allowed it to then take over the data center. And we're going to see the same thing here.
So that brings us to Edge and Nvidia and CUDA at the edge. We've got a comment here on tiny chips everywhere. We're high on RISC-V and of course ARM. We're talking about small data sets, extremely low power. Thank you, Andrew. Appreciate it's probably time to get off this slide. But David, what's NVIDIA's strategy at the edge? Are you as optimistic about their moat at the edge as you are in the data center? Why or why not?
Not nearly as convinced that they will take the whole thing. I mean, there's so much going to happen at the edge. There's so many. For example, the example we're giving here is that you're going to have tiny, tiny chips everywhere, and they're going to do a little bit of the analysis to reduce the data that flows up. And they'll be everywhere. Absolutely, they'll be in your alarm clock, and they'll be in your glasses and everywhere. So there is a huge opportunity at the edge. And I think that's the area where the NVIDIA systems are probably more open to other changes happening, and in particular RISC-V probably being a pretty strong player in that particular system. So I'm a strong believer of NVIDIA in the data center and on premise, but when it comes to the edge, I think there'll be opportunities for many players.
Okay, thank you. Let's bring up, Andrew, the last slide. I'll go through this, David, and then give you the last word. Kind of the things that we're watching in AI. Obviously, public policy, it's in the news, every day, Trump tariff, Trump, counter tariffs, et cetera, et cetera, et cetera. What's the impact of public policy on IT spending, on sentiment and AI enthusiasm, on the market, on interest rates? I mean, all of that is we've got to watch it. It's obviously a factor, and we'll pay attention to it. So will volume, value, and velocity outweigh cloud costs at scale, or will the on-prem vendors and their customers respond and build AI solutions that address the data gravity and other AI concerns? We think there's probably 18 to 24 month window for the on-prem crowd. We're talking here about HPE, Dell, IBM, Lenovo, maybe Oracle to a lesser extent because they've got a cloud. They're sort of more immune to some of those factors, but nonetheless, they've got hybrid activity going on, and all the ecosystem around that, the storage guys. Will they be able to cobble together solutions, proven solutions, so that we don't have a repeat of the cloud era, which was the cloud, even though maybe it was more expensive to rent, the value and the volume and the velocity were so high that cloud just washed over for a long period of time the on-prem spending, where on-prem was just flat. And of course, the on-prem vendors are doing better today, but a lot of that is going to neo clouds, which, by the way, our AI forecast includes the neo clouds. The colos are on-prem in our forecast. So I forgot to mention that earlier. But that's the opportunity that the on-prem folks have, is to put together those solutions and prove that they can handle the use cases. I mean, I think use cases like Salesforce automation and contact center probably going to go to the cloud, but those hardcore applications and systems in financial services and insurance and healthcare and life sciences and manufacturing that never went to the cloud, there's an opportunity for the on-prem folks to really do a better job, frankly, than they did with the cloud era of building out that stack. And that's something that we're going to be very closely watching. We will forecast, we as in David, and with my input, the single versus the general purpose robots, the single purpose versus general purpose robot. So we'll forecast that out early days, especially for the latter. And then, hey, we're going to test how the 3Vs methodology holds up over time. We're basically saying that the cloud is in a position to win a majority of the business. Most people would say that most of the workloads today remain on-prem. However, from a spending standpoint, as we've reported here, a lot of action happening in the cloud. Thank you, Andrew. So David, that's the summary. I'll give you the last word on this breaking analysis.
Well, thanks for the great work we've done together on putting this together. I've used the 3Vs methodology for a long time, but I think by formalizing it and making a process so that people can see what you're doing and be able to adopt it and use it themselves, I think that's a contribution we can make to this whole area, because things are going to change so rapidly. This is the biggest change ever in the speed of adoption of anything. It's faster than the internet and faster than electricity and faster than anything else you can think of.
Of course, Jensen said in his keynote, yeah, we saw it coming. It took 20 years. And as you and I remember when we were back at IDC, we were talking about AI. So in fact, the transformer innovations since that time, and the ChatGPT, AI heard around the world, now that's really catapulted us to the steep part of the S-curve. So David, thank you for your excellent contributions. The industry appreciates it, and look forward to more of your analysis down the road. Okay, that's it for now. I want to thank the Palo Alto crew, Andrew, Brendan, you guys. We really appreciate you stepping in for Alex Myerson and Ken Schiffman on production, and Kristen Martin and Cheryl Knight, who helped get the word out on social media and in our newsletters, and Rob Hof, who is our editor-in-chief over at SiliconANGLE.com. It's unbelievable, Rob, how fast you are able to edit and get content up. Our contributors like Zias Caravala and I continue to be amazed. Remember, all these episodes are available as podcasts. Wherever you listen, all you got to do is search Breaking Analysis podcast. I publish each week on siliconangle.com and thecuberesearch.com. And you can email me if you want to pitch me or get an idea for a guest, david.vellante@siliconangle.com, or DM me at dvellante, or comment on our LinkedIn posts. And don't forget to check out etr.ai. They continue to put out new data, fresh data, new innovations, awesome enterprise pulse. Opinions without data, just that, just opinions. This is Dave Vellante for David Floyer and theCUBE Research Insights, powered by ETR. Thanks for watching, everybody. We'll see you next time on Breaking Analysis.